Greetings, fellow investors. Welcome back to the Dividend Uncle channel, a treasure trove of financial wisdom and investment insights, seasoned with a pinch of Singaporean charm. Today, we're setting sail into uncharted waters, exploring a question that often puzzles even the savviest investors. When a share plummets, should you seize the opportunity or swim away? As dividend enthusiasts, we're about to dive deep into strategies that will help you navigate these tumultuous seas. So, grab your favorite kopi, and let's embark on this thrilling journey. The Plunge, understanding the 90% decline. Ahoy, brave investors. Imagine a ship caught in a whirlpool. A significant decline in share price can feel just as dizzying. What if it's a 90% decline? But let's not forget, what goes down may eventually come up, or will it? In this sea of plummeting prices, we're the sailors equipped with strategies to spot hidden treasures amidst the wreckage. In the vast ocean of investing, sudden and steep declines in share prices can leave even the most experienced investors with a sinking feeling. A 90% decline might seem catastrophic, but it's essential to remember that share prices can be influenced by various factors, including market sentiment, company performance, and external events. Before deciding whether to dive into this turbulent sea, let's explore a set of practical strategies tailored for dividend investors like us. These strategies will help us determine whether the current tempest presents a rare opportunity to uncover hidden gems or if it's best to wait for calmer waters. Strategy number 1: Unearth the root cause. Detectives of the financial seas. When prices plummet, the first order of business is to uncover the hidden rocks beneath. Investigate why the share price took a nosedive. Was it a company-specific issue, market-wide turmoil, or a combination of both? Just like we'd investigate a mysterious leak on our ship, analyzing the root cause of the decline gives us a clearer picture. When a share experiences a substantial decline, it's vital to determine the underlying reasons. Was the decline triggered by a company-specific event, such as poor financial results or management issues? Or was it part of a broader market downturn affecting multiple companies? Understanding the root cause will help you assess whether the decline is a temporary setback or indicative of deeper problems. Remember, not all declines are created equal. Some are short-lived storms, while others reveal more profound issues that might take longer to resolve. By investigating the root cause, you can differentiate between opportunities that are ripe for the picking and those that should be approached with caution. Strategy number 2: Assess the dividend health. The siren song of dividends. As dividend aficionados, it's crucial to ensure that even in rough waters, our potential investments can weather the storm. Investigate the company's ability to sustain its dividend payouts. Just like a ship's anchor holds it steady, a stable dividend record can be a lifeline for your investment. For dividend investors, the health of a company's dividends is paramount. When considering an investment after a 90% decline, assess the company's ability to maintain its dividend payouts. A stable dividend history indicates that the company has managed to weather challenges in the past and continue rewarding shareholders. Look into key financial indicators such as the dividend payout ratio, the proportion of earnings paid out as dividends. A high payout ratio might suggest that the company is struggling to generate sufficient earnings to cover its dividend obligations. On the other hand, a lower ratio indicates a healthier balance between dividends and retained earnings. Also look out for its gearing ratio, which is particularly pertinent in the current high interest rate environment, and the proportion of fixed rate loans. Don't forget to check the expiry of its interest rate hedges, which will turn fixed rate loans back to floating rate ones. Strategy number 3: Valuation, uncovering hidden value. Avast, ye investors seeking hidden treasures. Just as a sunken ship might carry untold riches, a plummeting share price can signal hidden value. Dive into valuation metrics like price-to-earnings ratio and price-to-book ratio. If the share price has sunk lower than the company's intrinsic value, you might be standing on the brink of a golden opportunity. Amidst the chaos of falling share prices, it's essential to assess whether the decline has created a disconnection between the company's share price and its underlying value. Valuation metrics like the price-to-earnings (PE) ratio and price-to-book (PB) ratio can provide insights into whether the share price accurately reflects the company's worth. For REITs, look out for the price-to-net asset value. A share price that has plummeted significantly might signal an oversold condition, meaning that the market has driven the price down to an unjustifiably low level. If the company's fundamentals remain sound, this could present an attractive buying opportunity. Analyze the company's financial statements, growth prospects, and industry trends to determine if the decline has created a disconnect between the company's intrinsic value and its current share price. Strategy number 4, the patient investor's perspective. Brace yourselves, patient investors, for the storm's passage. As dividend enthusiasts, we're in it for the long haul. A 90% decline might signal an opportunity for patient investors to buy into a solid company at a steep discount. Just as the tide eventually returns, stock prices can also experience a rebound. For dividend investors with a long-term perspective, a 90% decline might present a unique opportunity. While it's tempting to chase quick gains, patient investors know that the true value of an investment unfolds over time. Consider the company's long-term potential and its ability to adapt and grow. Is the company in a sector with promising growth prospects? Does it have a loyal customer base or a unique competitive advantage? By approaching the investment with a long-term mindset, you're positioning yourself to potentially reap the rewards of a rebound in share price as the company's fortunes improve. Conclusion: to dive or not to dive? So, fellow sailors of the investment sea, should you dive into the depths of a 90% decline? The answer lies within the waves of careful analysis and calculated risk. Investigate the root cause, assess the dividend health, uncover hidden value through valuation, and embrace the patient investor's perspective. Remember, even amidst the wildest storms, treasure awaits those who navigate with wisdom. Deciding whether to invest in a share after a 90% decline is a challenge that requires a blend of analytical prowess and intuition. Each investment is a unique journey, and understanding the underlying factors driving the decline is paramount. Keep in mind that while a 90% decline might seem alarming, it's crucial to assess the company's long-term prospects and its ability to weather the storm. As dividend enthusiasts, our ultimate goal is to build a portfolio that generates stable and growing income over time. So, set your compass true, analyze the depths, and navigate the seas of investment with the confidence of a seasoned sailor. Stay tuned for more of the Dividend Uncle's treasure trove as we chart courses through the world of finance and investment. Until then, may your strategies be sound and your dividends plentiful. Happy investing!